So I was explaining that okay, we have to compare the forward with the future. So here forward contract is slightly better. So we will explain the forward with the future. Then you will write that although option contract are generating lowest receipt, but if we select option, we have the right to lapse option if market becomes more successful. If the market becomes more favorable. So guys, what if market becomes more favorable? Option contract is locked, future contract is locked. You will not get the benefit of option. You will not get the benefit from the future and option market, future and forward market. But option contract has a beauty that if market becomes favorable, you will lapse the option, you will enjoy the market rate. And if market becomes adverse, you will exercise the option. So although option is not favorable here, but you can write the one advantage of option, that although options are not favorable, although option is not generating the highest answer, but if we select option, we have the right that if market becomes favorable, we can lapse the option and will enjoy the favorable rate of market. So you will compare future and forward, you will compare with the option, and ultimately at the end you will recommend the forward answer. You will recommend that derivative which is generating the highest answer in case of receipt. You will recommend that derivative which will be generating highest answer in case of receipt and lowest answer in case of payment. So any other question guys from this part? If all is okay, we will be moving to the interest rate. We will be moving to the interest rate risk management. Okay, let's move to the interest rate. Give me a minute. So let me cover this quickly, then we will solve question on it. Okay, we are going to cover the checklist, examples of requirements, common mistakes, and how to score the maximum marks. Interest rate risk management. It includes internal hedging, smoothing, and matching. What is smoothing? Smoothing is if you take half of your loan at fixed rate and half of your loan at the floating rate. So for example, if you have 100 million borrowing, take the 50 million borrowing at the fixed rate, 50 million borrowing at the floating rate. What will happen? If interest rate increases, you will face risk from the floating rate payments, but you will get benefit from the fixed rate loan. And if interest rate reduces, you will get benefit from the floating rate, and obviously you will face risk from the fixed rate interest. So overall, your risk will be smoothed. Overall, your risk will be smoothed. That is smoothing. Taking half loan at the fixed, half loan at the floating. What is matching? Matching is match the interest rate liability with the interest rate assets. And that can only be done in the banks. In banks, you have interest based receivable, you have interest based liabilities. And both, if you book all your receivables at the floating, if you book all your payable at the floating, if interest rate increases, you will face risk on the liability, but you will get the benefit from the assets. So this is matching. External hedging methods are forward rate agreement, interest rate future, options, collar, and interest rate swap. FRA, interest rate future, option, collar, and interest rate swaps. And other knowledge are comparison between forward and future, advantage and disadvantage of derivatives, and mark to market calculation. This is the other knowledge which you need. So in order to get the mark to market calculation, there is a question in past paper named Daikon company. Do revise that question in order to get the maximum of this mark to market calculation. So let's have a quick look on the steps, that how to solve the forward and future steps. So let's have a look at the let's have a quick look. Interest rate future. Number one step. Identify borrowing or lending. Identify borrowing or lending. Number two step. Identify buy or sell future. It's very easy. If you want to pay interest, sell future. If you want to receive interest, buy future. If you want to pay interest, sell future. If you want to receive interest, buy future. And who is going to pay the interest? Borrower. Who is going to receive the interest? Lender. So if you want to pay interest, sell future. If you want to receive interest, buy future. Third step, settlement date. Fourth step, contracts. It has a different formula. Contracts, number of contracts. Loan amount divided by contract size into duration of loan. Duration of loan divided by 3, because 3 is the number of months. 3 are the number of months of future. Futures are usually of 3 months. Futures are usually of 3 months. Okay, next is calculate closing future. Calculate closing future. Remember, always use this formula which I'm going to write here, and that is closing future is equal to closing spot plus closing spot will be given, and normally two closing spots are given in the question. Normally two closing spots are given in the question. Closing spot plus opening future minus current spot into remaining months divided by total months. Closing spot will be given. Normally two spots are given, one with the rising interest rate, one with the falling interest rate. Normally two interest rate, two spots are given, two spot rates. Two spots are given. One with the falling interest rate and one with the rising interest rate. Given opening future. Current spot is given, current LIBOR. Okay. So closing future, use this formula, you will be able to calculate the closing future. And once you are able to closing future, compare opening and closing future. And calculate gain loss. Close the contract. Close the contract and calculate gain loss. Opening future, closing future, gain loss. And if you are using the ticks, gain loss will be in ticks into tick value. There are different ways to solve this. Into tick value, into contracts. And the last step will be actual borrowing in the market. Actual borrowing in market. Gain loss on future. You will be calculating net interest payment or receipt. Net interest payment or receipt. So these are the steps which you will perform in calculation of interest rate future. In calculation of interest rate future. Okay. Don't worry about that. These steps are very easy. Let's start the question. Let's solve the interest rate future first. Then I will write the steps of option. Then we will solve the option part in that question. Please open the latest attempt question. The latest attempt question. The March, September, December 21 question. September, December 21 question. Please open. Question number 2. Okay. So I am directly reading the part number 2, B part. Recommend hedging strategy for the 36 million loan based on the hedging choices. The treasury manager is considering if the central bank base rate increases to 6.6%. So if your interest rate increases to 6.6%, what hedge you will use? Support your answer with the appropriate calculation. So guys, let's solve this part. And before solving this, let's read the scenario quickly. Believe me, after solving this question, you will never face problem in the interest rate future and option. That is guaranteed. Brandon Company is a holding company operating a small chain of luxury department store in city center location throughout the Eurozone. Under the existing structure, the stores are grouped into a number of regional subsidiaries, each with their own head office and treasury function. So that means you were following decentralization previously. Decentralization. Every store, every company has its own head office and treasury function. The board plans to undertake a restructuring exercise in response to a significant decline in revenue over recent years. This will involve closing unprofitable stores within the Eurozone while expanding into other more profitable locations worldwide. The proposal represents a significant expansion for the company and will be financed by a combination of debt and equity. The restructuring is due to be discussed at the upcoming board meeting, including the possibility of centralizing the treasury function. So guys, actually you are shifting from decentralization to the centralization. You are shifting from decentralization process to the centralization process. So this question has been tested in the A part. So let's discuss specifically the B part. Assume that today date is 1st November. Today date is 1st November. Please highlight this. This is very important. Brandon Treasury Manager predicts a short-term loan of 36 million will be required on 31st January. So you need a loan of 36 million on 31st January. To fund an investment in non-current asset as a part of overseas expansion, loan will be repaid on 31st March. So what is the duration of loan? Feb, March, April and May. 4 months. 4 months is the duration of the loan. 4 months. Brendan Company can borrow at the central bank base rate plus 40 basis points. So, and currently base rate is 5.7%. The interest rate have been relatively volatile over the last few years, and the finance director is concerned that central bank could increase the base rate to 6.6% between now and 31st January. The recent media report have also speculated on the possibility of a reduction in the base rate. So some media are also saying that interest rate can go down, but majority are saying rate will increase. Hedging. Brendan, treasury manager, would like to investigate smoothing as a technique to manage the company's future exposure to interest rate risk. But for the purpose of this transaction is considering the following hedging possibilities with the objective of minimizing exposure to the interest rate risk. Forward agreement, interest rate future option. Firstly, we will solve the future, then we will solve the remaining two. For FRA is given, this is future, $500,000 contract size, yields are given, this is the future. Assume future and option contracts are settled at the end of month. Basis is assumed to diminish to 0. Okay, it is also assumed that there is no basis risk and there is no margin requirement. So let's solve the future contract first. Let's solve the future contract first. So I'm solving the future contract first. Interest rate future. So the number one step is the borrowing amount. Borrowing amount. That is $36 million. $36 million. Second step, as you are borrowing, as you have to pay the interest, so that means it will be a self future. Self future. For loan, it will be a self future. Which contract? We are borrowing on 31st January, right? We are borrowing on 31st January. So we will choose which contract? March contract. 93.95. March contract. March contract. 93.95. You can convert it into percentage. Simply write in the percentage, that is 6.05. 6.05. You can also write in the percentage, that is 6.05. 6.05. March contract. So we have selected the amount of borrowing by our self future March contract. Now identify the number of contracts. That is 36 million divided by 0.5 million. Contract size is 0.5 million into duration of loan 4 months divided by 3. So the number of contracts are 36. Sorry, 96. Number of contracts are 96. Why we are choosing March contract? Remember, when you are taking the loan, identify when you are going to take the loan. When you are going to take the loan, you are going to take the loan on 31st January, right? So select the date immediately arriving after the date when you are taking the loan. If you are taking the loan on 31st January, select March contract. If you are taking the loan in May, select the June contract. While selecting the settlement date, always select that settlement date which is coming just after your loan date or lending date. So number of contracts are 96. Please, it is 36 divided by contract size. Contract size is 0.5. Contract size is 0.5 million. 0.5 million. Into duration of loan is 4 divided by 3. Number of contracts are 96. So guys, what is the next step? Closing future. So identify the closing future formula. Closing spot, opening future minus. So you can write the closing future at in the working as well. You can solve the closing future here by showing the working here. Working. First of all, identify the closing spot. It is written here, closing spot will be 6.6. Now identify the closing future. Formula is closing spot minus opening future, that is 6.05, minus opening spot. Opening spot is 5.7%. 5.7%. Into remaining months. Remaining months are 2. Divided by the total months. Today is 1st November. Contract is of it's plus sign. Let me explain This is closing spot. Let's write the opening spot or current spot. Let me write all the data for you people. Current spot is 5.7. 5.7. Okay. When you are today date is 1st November. Loan date is 31st January. Okay. Now calculate the closing future. Okay, guys, I'm going to apply this step. Closing spot plus opening future minus current spot into remaining months divided by total months. So guys, current spot is on 1st November. Future will be of 31st March. So calculate the months. November, December, January, February, March. 5 months. So total months are 5. You are executing your contract on 31st January. So the remaining months will be 2. Remaining months will be 2. So let me apply the formula here. Closing spot is 6.6% plus opening future will be 6.05. Current spot is 5.7. You can write a percentage here into 2 divided by 5. Please identify what is the closing future. Guys, please identify what is the closing future. In interest rate future, closing spot will always be given. In currency future, closing spot will never be given. In currency future, closing spot will never be given. In interest rate future, closing spot will always be given. Even 2 closing spots will be given. So let me apply the formula. Closing spot, always put the plus sign, opening future minus current spot into 2 divided by 5. 6.74 closing future. Close the contract. Opening future is 6.05. Closing future is 6.74. So you have locked your position that you will be paying 6.05. You have locked your position that you will be paying 6.05. Now interest rate move to 6.74. So gain will be 0.69. 0.69. So convert this into ticks. This will be 69 ticks into tick value. Tick value is for 500,000. Tick value will be 12.5. Guys, remember how to calculate the tick value. Tick value is contract size into 0.01% into 3 by 12. Please calculate the tick value. Tick value into 3 by 12. 12.5, right? Tick value will be 12.5. So 69 is the number of ticks. Divide the 0.69%. It is in percentage. Divide the 0.69% with 0.01%, that is 69 ticks, into tick value 12.5 into number of contracts 96. So 82,800 is the gain. There is another way of solving this. There is another way, by the way. There is another way. That is multiply the gain into number of contracts into contract size into 3 by 12 into 3 by 12. So there are multiple ways of solving this. It's not loss. It's not loss. You have booked the future at 6.05. That you will pay interest at 6.05. But market moves to 6.74. So it's a gain actually. It's a gain. Okay. I'm explaining in a percentage. If you solve in this way, right? If you solve in this way, then you are right. Then you think like that. If you solve in inverse terminology, then you are right. Then you think in buy sell type calculation. But if you are thinking in percentage, then you have to think that you have locked your position at 6.05. Market moves to 6.74. It's much easier compared to the other type. So guys, there are two ways to convert the percentage gain into absolute gain. There are two ways. Number one is this is 0.69%. 0.69% into number of contracts 96 into contract size 500,000 into 3 by 12. You have to multiply with 3 by 12 because future is a time duration of 3 by 12, 82,800. There is another way, that is convert this 0.69% into ticks. It will be 69 ticks into one tick value is 12.5. If contract size has 500,000 amount, tick value will be 12.5 into number of contracts, that is 96. So it's up to you whether you want to use this calculation or this calculation. It's up to you. Last is closing future formula. No, it will be the same. So let's do with me. Let's do with me. Number one, what you are going to select closing spot, that is 6.6, right? Okay. Plus, put the plus formula. Put the plus formula. Bracket start. Opening future 6.05 minus current spot 5.7. Bracket close into how many remaining months? 2. What are the total months? 5. 6.74. Okay. Last step will be borrowing at actual rate. Borrowing at actual rate. Yes, closing spot rate is given in the question, in the requirement 6.6. It is given in the requirement 6.6. Okay, actual borrowing. If you are borrowing in the market, it is given how at what rate you will borrow. Base rate plus 40 basis point. Base rate plus 40 basis point. So now what is the base rate, guys? Base rate is 6.6% plus 6.6% plus 0.4. So borrowing at actual rate is 7. Now market moves to 6.6. 5.7 was the previous rate. Gain on future is 0.69. So effective cost will be 6.31. Obviously, you can convert into the absolute amount. Loan amount is 36 million into interest rate is 7% into 4 by 12. This is the absolute amount. And net amount will be okay. What's wrong with this percentage? So that's how you are going to calculate absolute amount, or directly you can write in, you can solve in percentages. Any question, guys? Okay, let's move to the next part. Last steps are common in option and future. You will write that you will borrow at the actual rate. Go to the question and identify what is the actual rate of borrowing now. Interest rate moves to 6.6%, right? Interest rate moves to 6.6%. Plus, whenever you are doing the borrowing, you have to pay the spread. That is 0.4. Spread will always be considered in the last step. Spread will always be considered in the last step. So 6.6 is the base rate, 0.4 is the spread. So your borrowing cost will be 7%. Gain on future is 0.69. So the net cost will be 6.31. Next, net cost will be 6.31%. And if you convert the 7% into absolute amount, how you will do it? 36 million into 7% into 7% into 4 by 12. 4 by 12 is the duration of the loan. This 82,000 you have already calculated above, and when you calculate the net of it, 750,200 is the cost of future. So net cost will be 6.31%. Okay. So now quickly revise the steps of option and then solve the option. Option contract, interest rate options. First step is same, amount of borrowing or lending. Amount of borrowing or lending. Second step is identify call option or put option. Call option or put option. Call mean right to buy future. It's on the future contract, right to buy future. And when you do the buy future, when you receive interest, receive interest means lender. Put option mean right to sell future when you pay interest. And when you pay interest, when you are a borrower. Next, identify settlement date. Next, contracts. Borrower will always sell future. That's it. That's a rule. That's a rule. Now, premium cost. Premium cost. Convert the premium into tax. Convert premium into tax into take value into number of contracts. Or there is another way, number of contracts into contract size into premium in percentage into month portion. Month portion. 3/12 month portion. Then decide to exercise the option or not. Decide to exercise the option or not. By comparing strike price with closing future price. Always compare the option with the closing future price. Closing future price. Either it can only be gain. In case of loss, you will not be exercising. In case of loss, it will not be exercised. It can only be a gain. In case of loss, you will not be exercising. Last step. The similar step, actual borrowing cost or actual lender income, gain on option, and the last one is premium cost. Net interest cost. So that's how you will solve the the option contract. Let's solve it. Let's solve it. Option on future. Remember, it's option on future. Borrowing 36 million. Okay, as we are borrowing, so that means it's put option. Put option. March put option. And exercise price will be 93.75. Exercise price will be 93.75. You can write it 6.25. Okay. Now, number of contracts 36 million divided by 0.5 million into 4 divided by duration of option, 96 contracts. Just check the contract size is same. Yes, the contract size is same. Okay, next is now calculate the premium cost. Premium cost. Okay, what is the premium cost? Put option 0.087. Okay, put option 0.087, right? Is it correct? 0.087. 0.087. 0.087 means 0.087. Okay. 0.087 means 8.7 ticks. 0.087, right? $8.7 into 12.5 into number of contracts are 96, 10,440. Or you can also use number of contracts into contract size into 0.087 percentage into 3 by 12. You can also use this way. Tick value is tick value formula is contract size into 0.01% into 3 by 12. Okay. Premium cost. Now decide to exercise the option or not. Write the strike rate. You have booked that you will pay 6.25, but market moves to, what is the closing future? Market moves to 6.74, right? Market moves to 6.74. Guys, is it a gain or loss? You have locked at 6.25, market moves to 6.74. Gain or loss? You have done the contract at 6.25. You have done the contract at 6.25 that you will pay interest at 6.25. Market moves to 6.74. You have done the contract that you will be paying interest at 6.25. Market moves to 6.74. Gain. So you have two choices to convert the gain into absolute amount. One is convert it into ticks, 49 ticks into this is the formula to calculate the tick. It's just the formula to calculate the tick. Contract size is 500,000, right? Contract size is 500,000, right? Into tick value 0.01% into 3 by 12. There is no logic behind this. This is the formula to calculate the tick value. We are not discussing the logic here. It is just the formula to calculate the tick value. I'm explaining both of the ways. Either you can use the tick value or without the tick value. Like if you are using the tick value, these are 49 ticks into 12.5 is the tick value into number of contracts are 96, 58,800. Okay, if you say, sir, I don't want to use a tick. Okay, if you say that, sir, I don't want to use a tick, there is another way. That is number of contracts, 96, contract size 500,000 into 0.49% into 3 by 12, because futures are of options are of 3 months. Yes, Mira, you are right. We need to know about text for the. If you don't know about the text, that is perfectly okay. That is perfectly okay. That's why I am explaining both the ways. Don't worry about that. That's why I have explained both the ways. If you know the tech, that is okay. If you don't know the tech, there is another way to solve it. That is number of contracts 96 into contract size 500,000 into 0.49% into 3 by 12. Don't forget to multiply with 3 by 12. Last step, borrow from market. Copy from above, borrow from market. Because borrow at actual rates will be same both in future and option. Gain on option. Premium cost. Net receipt. Net interest cost. 6.597. So that's how you will solve the option contract. Okay, if you are thinking that texts are complicated, ignore that. You can ignore that. Even guys, if you don't have time, solve it in percentages. Just convert the last, just convert 3. Convert the gain into absolute amount and this calculation the absolute amount. It will be perfectly fine. You will get the full marks. Because it is the decision that matters. Okay, it is the decision that matters. Any question, guys? Could you say that again, please, about the using the percentages if you don't have time? If you don't have time, calculate only these percentages. Just try to convert into absolute amount this gain amount and the last net interest cost. That is okay. It will be perfectly fine. Closing future above 6.74. I have copied this 6.74 from above. It is the same closing future which we have calculated from above. 6.74. It is the same 6.74. Okay. Okay, there is another question. Net interest is the ending gain, is the ending interest expense after considering gain and premium, which is favorable because it is still lower than market. Which is favorable. Yes, it is slightly lower than the market. Slightly lower than. Yes, you are right. And which, okay, last one is still remaining. There is another requirement that was forward agreement. So you will, which forward agreement you will select? Today is 1st May. We are going to borrow on 31st January. So we are going to borrow after 3 months. For how many months? For 4 months. So it is 3 has 7. If there is 2 exercise prices, preferably solve with 2 exercise prices, because examiner always solve with 2 exercise prices if 2 are given. So guys, you will select this FRA 5.9%. Forward rate agreement. Company will lock 3 has 7 FRA at 5.9%. If market moves to 6.6%, we have locked at 5.9, so we have a gain of how much? 6.6 minus 5.9. 5.9%. We have a gain of 0.7%. 0.7%. And actual borrowing cost is so let me shift this into the next cell. Actual borrowing cost is, market has moved to 6.6 plus 0.4%. So final cost will be 6.3%. And if you want to convert it into the percentage, into the actual amount, you can convert it. 36 million into 0.7% into 4/12. 36 million into 7% into 4/12. So the effective cost will be sorry, 831,600. This is the effective cost. Okay, minus 84, I think something 36 million is 756,000. 756,000 is the amount. So that's how you will solve overhead agreement. Which one is better? Forward agreement 6.3, option 6.6, future is 6.31. So which one is better? FRA and future are almost same. You will compare it and then you will recommend the forward answer, because forward is slightly marginally better. But you will also write in exam that we should also consider the option contract, because some of the media teams are speculating that interest rate will come down. If interest rate comes down, we will lapse the option, we will take loan at the market rate. So in option, we have the option to enjoy the market movement. Okay. Guys, you will compare for FRA with the future, but you will also write the option contract. Although option contract is not beneficial here, but still it is in your still, if market moves, if like some of the media outlets are suggesting that market can come down, interest rate can come down. If interest rate moves down, Your position will be locked in future and forward, but you can enjoy the market movement if you have booked option contract. Okay. Is the money market has still in the syllabus? Yes, it is still in the syllabus. It is still in the syllabus. Uh, can we say that FRA has the best interest? However, the option give flex to the company and that should be considered. Yes, you right, but you have to explain it. Explanation shouldn't be in like 2 lines. You have to explain in at least 4 to 5 lines. Which calculation? Forwarded is very simple. Which contract you have logged 5.9%? You have logged 5.9%. That means you have logged that you are going to pay 5.9%. Market moves to 6.6%, right? You have logged 5.9, market moves to 6.6. So that means you have a gain of 0.7%. You have logged your position at 5.9, market moves to 6.6. You have a gain of 0.7%. Actual borrowing cost is 7% because now interest rate is 6.6 plus 0.4 is the actual spread. So actual interest cost is 7%, your benefit is 0.7, net cost will be 6.3. And I convert that amount into absolute amount by multiplying with the loan amount and taking the month portion. Actually, we will give all the reasons. We will compare FRA with the future, then with the option, and you can write that overall forward is better. So we will select forward on the basis of financial analysis. Means on the basis of benefit, we will select the forward agreement. It is 756,000. Future net interest cost. Future net interest cost is 757,200. Yes, you're right. Okay, there is another question. Will we go through the collar and chops? Actually, we don't have enough time, but I have a video available on swaps. I will share that. But we can briefly cover the collar contract. Let me explain in few minutes the collar contract. If forward and future give same cost, then which will you recommend? Look, forward contract is easy because in forward you do not have to deposit the margin. In forward you do not have to under hedge or over hedge. You will do the exact hedging. In forward you do not have to face the basis risk. So you will go with the forward contract, but there is a problem with the forward contract, the default risk. If the counterparty rating is high, if the counterparty risk is okay, then you will go with the forward contract. Okay, guys, I'm explaining the borrower's collar. Borrower's collar. I will take few minutes, but this is very important. Borrower's collar, and this is very simple. Please tell me which option borrowers normally buy. Please tell me which option borrowers normally buy. Anyone? Borrowers. It is the put option or the call option. put option. Remember, everyone remember this, right? So borrower will buy put option. Buy put option. And it's a rule at higher rate, at higher interest rate, at higher interest rate. Higher interest rate, or if two option prices are given 7 or 6, put will be at 7%. At higher interest rate, you have to pay the premium. You have to pay the premium. So guys, borrower will always buy the put option. Borrower will always buy the put option at higher interest rate. Please mark these words. I'm not telling you the higher strike price, higher interest rate, because normally strike prices are given in inverse term. It is given as 93, it is given as 94. I'm not talking about strike prices, I'm talking about the interest rate. Borrower will buy the put option at higher interest rate. Okay, but the problem with that is it is expensive. It is expensive. So what you are going to do? Take the opposite position in call option. Take the exact opposite position in call option. Exact opposite position. If you have bought the put option, sell the call option. Sell the call option at lower interest rate. At lower interest rate. You will receive premium. You will receive premium. Overall, lower cost. Overall, lower cost. For example, guys, if we take our question example, what was the strike rate? 6.25. Put option at 6.25. So let's suppose you have bought the put option at 6.25% and sell the call option at 5%. Let's suppose we assume you have set the caller at 6.25 put, 5% call. So now you will compare with, this is the first step. Second step, compare with it with closing future. Compare it with closing future. Let's suppose closing future is 6.74%, right? 6.74%. Guys, remember, if you set the caller, interest rate can never move above to 6.25. Interest rate will not move above the 6.25. And by the way, interest rate will also not move below the 5%. So if interest rate, if the closing future, always compare the caller with the closing future. Always compare the caller with the closing future, not the market interest rate, because option will always be on the future. Option will always be on the future. So that's why compare the option, compare the caller with the closing future. Compare the caller, mark my word somewhere. Compare the caller with the closing future. So guys, if closing future is 6.74, anything above this will be exercise. Anything below this will be exercise. Anything in between will be okay. Anything above 6.25 will be exercise. Anything below 5% will be exercise. So guys, 6.74%, which option will be exercise? Put or call? Which option will be exercise? Put option. Anything above this will be exercise. Anything below this will be exercise. So put will be exercise. Put option will be exercise. And who has the put option? We are the borrower. Who has the put option? We have the put option. We have the put option. Guys, if we have the put option, we will only exercise if we are getting the gain. If we are getting the gain, 6.74 minus 6.25. So gain will be 0.49%. 0.49%. Second scenario. If closing future is 4.75%, If closing future is 4.75%, anything above 6.25% will be excised. Anything below 5% will be excised. Any rate between these two will not be exercised. So anything below 5% will be excised. 4.75% is the below rate. So call will be excised. Call will be excised. Guys, who has the call option? Do we have the call option or the other party has the call option? We are the borrower. Do we have the call option or the other party has the call option? Sell call option means other party has the call option, right? Counterparty has the call option. So when counterparty will excise, when counterparty is having the gain. So that means we are having the loss. So in this case, it will be a loss. Guys, when other party is exercising, that means other party will have a gain. And we have a loss. Third scenario. If closing future is 5.25, 5.25, even 5.1, let's take it 5.1. It will not be excised, even it will not be excised. If interest rates are in between these two, nothing will be, no option will be excised. No option will be exercised. Okay? No option will be exercised. Last step, actual borrowing cost. Similar which we have done in future and option. Net premium, gain loss on caller, gain loss on caller, net cost. That's how you will solve this in exam. All these rates are before the company spread. We will only consider spread in the last step in actual borrowing cost. If no option is exercised, you will not write this. Obviously, you will not write this. Okay. Last and most important thing, if you want to contact guys, this is my number, and on YouTube you can search with my name. On Facebook it is slightly different. On Instagram it is this. Contact me on YouTube. Full playlist is available. Full playlist is available for AFM, and I'm very sorry I was not able to explain everything of AFM because of limited time. But if you go through the playlist, you will find many useful video, that is for sure. And one of the video is interest rate swap. Do subscribe the channel, press the bell icon, share and forward. Okay. All the videos will be uploaded soon on the YouTube. Don't worry about that. It will be uploaded on the YouTube. Today is the last day of the webinar. For practice, solve at least last 5 attempts question. Latest 5 attempts question. I wish we would have a one day more, but today is the last day. Thank you so much, guys. Please add yourself in the WhatsApp group. If you have any problem, any issue, do let me know. I will be available there, and we have many good students in in those groups. If I'm not available, any other will help you out. Can you suggest specific question to do on ACCA portal? I have explained this in the first class that there are total 18 questions, 18 to 21. 18 to 21 questions are available. Try to solve all those questions. Try to solve all those questions. Okay. Thank you so much, guys. Best of luck for the exam. It was a wonderful session. Thank you so much for all the cooperation on ACCA portal. These are 18 questions on the ACCA portal. ACCA practice platform. Take care, guys. Thank you so much. Allah Hafiz. Good evening.